Good afternoon and welcome to the Perspecticast, the podcast accompanying the Panda Perspective Substack. We are in sunny Yorkshire this week as we are approaching Easter in the Western Hemisphere. And I thought it'd be an interesting opportunity to see if we can spice up our weekly sessions a little bit with a change of venue. So behind me is the Peace Hall, the English take on the classic Italian piazza dating back to the 18th century, and beautiful it is too, and still thriving with shops, restaurants, and as a venue. So if you're ever in the north of England, do consider checking it out. It is quite lovely. Another thing I wanted to mention on the part of admin is to do with the fact that it is a festive period. The Easter is upon us, and as with other festive periods, we're trying to celebrate with a discount. And the Panda discount is back, 20%. Should launch sometime today, a Monday, and should last all the way through till end of Easter, so next Monday. Please take advantage of this opportunity if you haven't before, and I will be very happy to see you as members of the broader Panda community. Now, on to the note itself. I wanted to re-highlight what we learned from Friday. I think it's getting more salient by the day with the more recent developments, with the tariffs on and off and on and off, and exemptions and no exemptions and exemptions again, but not without exemptions. And it's getting confusing. But ultimately, I think the line's drawn. At this point, it's clear what is being done. I think this Besant-Mirren framework of global pools of friendlies and unfriendlies is what they're aiming for. The only problem is, I think, people aren't quite sure what happens in the event when the pool of friendlies is smaller than you'd like, and then you need to reach across, and then the other guys are sitting in the red bucket already. Quite frankly, it has always been the weak point of this framework. Again, let's maybe restate it again. There is absolutely a rationale for the rebalancing of trade flows, right? I mean, this morning we saw the release of the trade figures in China. The run rate right now is $1.1 trillion a year, 275 billion last quarter. Crazy numbers, 100 billion in March alone. It's really quite something, right? And yet, the way they're approaching it is very much focused on the numbers themselves as to the causes of these numbers, right? If you don't address the root cause, even if you rebalance the end result, you keep coming back to the same issue yet again. Or you break stuff eternally, right? And always talk about how US is the bigger player, therefore it will survive better. It's not the bigger player in purchasing power parity terms, and of course it's not a perfect metric, etc. But GDP in itself is not a perfect metric, right? I mean, all these things are theoretical constructs, right? I mean, at this point, it's clear that China's manufacturing prowess is an asset that they can exploit. They exploit and have been. The America's consumerism is an asset they've been able to explore way beyond the power of the military or anything like that. Access to the US market has been a super valuable tool to get people out of poverty across the world. You know, got to acknowledge that. That's been the case for some time, and it's very important to understand that this method also helped the US, right? Outsourcing jobs did create new jobs, lots of them, and they're a lot more high paying. Like, just look at those average wage numbers and national income data, right? I mean, the US is doing really, really well. Now, obviously, there are questions of inequality and pockets of destitution, things like that, where old industry is gone and new one hasn't appeared. Right? I mean, let's work on that instead of just throwing the baby with the bathwater. But whatever, nuance is not what people are going for these days, at least not the present administration. The interesting thing about the data coming out today that I found, at least, was that the reason we had a big boost in the Chinese trade numbers was that the oil's cheap, right? They continue importing oil and ore in big volumes, and because of that price contraction, the overall imports have slid. But those are not finished good imports; these are raw material imports, which is interesting because, of course, the Americans are the ones pushing for lower oil prices because they want to keep their inflation in check, given the tax bill they've passed and the general approach to economic management that they're trying to implement. I would just like to point out that the end result of this is rerouting of trade, right? It's not the end of trade, it's the rerouting of trade. And at no point do we believe that America is going to be making cheap tat, right? That's not what they want to do. That's not what they will end up doing. And if they do, then that's going to be terrible for the American consumer because who on earth is either the prices will have to go up a lot for most things, all the way through to income go down because at current prices you cannot pay American wages to produce all these things in America. So okay, that means that trade will have to come from someplace. Now there is talk about how Apple is going to make more iPhones in India and in Thailand, potentially in Vietnam for sure. Okay, but how soon and how many and how much of that is going to be a rebranding exercise of taking Chinese stuff and just saying made elsewhere in the world? I don't know. Let's find out is the answer. But to what extent the US customs would be interested in figuring that out? Because of course, would you like to have a doubling of the price of the iPhone this coming product announcement cycle? Probably not, right? To what extent you can rely on these Vietnamese and Thai production sites to pick up the slack if you have to take Chinese production online this year? Not to a great degree. And in general, given the way that Apple product cycles work, the Vietnamese and Taiwanese and Indian factories will probably be factored for iPhones 19, 20, something like that. But until that time, we're kind of stuck with what we have. And that is a blueprint for everything else. And again, the things that read out the fastest are cheap tats. So the things that you least want to be brought back, it's just what it is. Again, we continue to advocate for greater pushes on domestic demand. Obviously, the NPC recommendations are being implemented, so let's see how that all plays out. However, the negative impacts of the Besant thing is, of course, that now we have to worry about things like ADRs. And if one needs to worry about the term people keep using is getting Gazprom, but I actually be more worried about a unilateral move on the US side to move trading in Chinese ADRs OTC. Is it something that is feasible? Yeah, for sure. Is it a problem for most things? I don't know if it's a problem, but for sure that's not good news, right? So for that point, if you can move your Chinese exposure to Hong Kong or better yet onshore A shares, if you don't have a broker that can do it, reach out, get a new broker. In this bipolar world, or multipolar world, whatever you want to call it, it is reasonable to have financial intermediaries in both parts of, or however many parts you see to this, and have accounts set up, right? Don't put too much money in, but well, I say that this is not financial advice, right? This is just exploring an idea. Make whatever amount you're willing to allocate to China, do it through an Asian-based broker. Singapore is a great place for it. Hong Kong is a fantastic place for it. Do that. Focus on that. And that way, worry less about ADRs. Now, of course, we have some companies that do not have a Hong Kong line. I'm looking at DT, for example. Obviously, that will be a concern that needs addressing. But all of it gets resolved. And interestingly, at the end of this road is a Hong Kong as a viable alternative to US. Like right now, it doesn't seem so, right? It seems like there's a mismatch in terms of assets, in terms of turnover and all that stuff. But as international listings get actively pushed out of America, Chinese at this point, but how far do you have to go before some other big listings get turned away, right? Or at some point, European companies stop seeking US listings because why would they, right? With all these threats and limitations imposed on Chinese players, who's next, right? The challenge of reputation and narrative risk, right, is that it's very hard to quantify and it's hard to immediately say this is where the line is or this is where the line is going to be drawn, because at some point you just start thinking about risk factors, and that is a very challenging road to go down, because once you start thinking about things that can go wrong, you can come up with a very long list, and at that point you're like, okay, well, all of a sudden maybe there is value in these exchanges, because, and again, this is something that we've discussed on occasion before, but one of the bigger, maybe underrated trends of a post-GFC world has been the centralization of trading in America. Maybe to Americans, they didn't even notice. They just saw all these new companies from all over the world continue flocking to the US. And they would say, well, this is nothing new. We had Russian companies in the 90s, and then South American companies in the mid-2000s, and Asian Chinese companies from late early 2000s to 2010s. Like, they all came here, they all listed here, they all raised money here. This is normal. And the answer is no, it's not normal. Traditionally, local exchanges would play a big part in local liquidity pools. And in most places, it just hasn't been the case. The flow has been very much one way towards greater centralization in America. What happens is this flow gets reversed, well, regional champions will emerge, and some exchanges will regain some of their lost luster. The UK, for example, out here, the FTSE obviously is a great example of what happens to an exchange that does lose its core advantage, because, like, how is it better than, in what way is it better than you are? Well, okay, some takeover code bits are different and maybe better, but in general, it's a very similar idea of rule of law and everything being in English. And, of course, cheap liquidity trumps that as a general rule, but now it's not just about that. All of a sudden, maybe the mining companies will come back to London properly and start raising money in London properly, assuming London is willing to take them and willing to do what's necessary. But, using London here just as an example, because of course the biggest beneficiary will be Hong Kong Exchange, right? Hong Kong Exchange is willing to take those Chinese listings, Indonesian listings, Philippine listings, whatever. They're welcome, and they will probably follow if the Boston Nasdaq is closed. Though, of course, this is not a story for this year, because let's be honest, Indonesia, Philippines, not in great shape right now to begin with. So the recovery presumably comes at some point, and it will probably come through greater trade within Asia. Which brings us to the final point of today's note, which is the Xi Jinping travels in Vietnam, Malaysia, and Thailand this week, as opposed to talking to President Trump on the phone, or maybe in addition, let's find out. The point is that China needs to drive inter-Asian trade. They're willing to put effort behind it, and they're needing key allies to engage with them on this. Vietnam, Malaysia will have to be those entry points. Now, of course, Indonesia is the biggest market, but then also it's the most protected, and I think Prabowo will find a way to negotiate with Xi Jinping eventually. So I'm not too worried about Indonesia, maybe in terms of not being a part of it, but rather only on terms, and also on the economic prospects for the country that is, well, I suppose we can do a separate episode or a note on Indonesia and what's happening out there, but it's not all signs are pointing up anymore. So, but we'll explore it. The bottom line is China's push into Asia is reasonable, and this is the sort of thing that helps see the rebalancing of trade and develops. On that note, have a lovely rest of the week, festive week out here in Europe. I personally am going to be a little bit more festive than usual, but a big new report is coming on yet another robotics company, so that's probably Wednesday. I'm very excited for that. I'm sort of probably 3/4 of the way through writing it, so quite excited about it. And then, obviously, we continue with preparations for a trip to Hong Kong that is happening in May. So reach out if you're around. Obviously, very excited to catch up because I missed Hong Kong, and I'm very much looking forward to spending a lot more time over there this year. On that, have a good one. Speak to you later.